a comprehensive guide to mastering chart patterns for day trading. Success in day trading depends on being able to accurately predict near-term price movements of futures contracts, foreign currency pairs, or stocks. Day traders use technical indicators to accomplish this task. Such indicators include chart patterns like trend lines, price-to-action configurations, or Japanese candlestick formations. This approach works because price patterns in markets tend to repeat themselves in similar situations. Thus, a day trader who sees that a specific chart pattern is developing can accurately predict how that pattern will play out and trade accordingly. The first key to making this work is to learn those patterns and practice using them in simulation until one routinely makes paper profits in simulation trading before risking one's own trading capital. The second and most important key is to exercise discipline in following proven trading strategies in both up and down markets. By identifying specific chart patterns, a day trader can choose the best points at which to buy or sell in a given market. Common chart patterns include the symmetrical triangle, in which price highs and lows converge to almost a point price. Breakouts from the lower part of the triangle indicate that prices are going lower, and breakouts from the higher indicate a trend upwards. Both ascending and descending triangle patterns seen in rising and falling markets likewise indicate a trend breakout or accentuation when prices rise or fall away from the triangle pattern. The head and shoulders pattern is comprised of three price peaks, the first and third being lower than the middle one, thus looking like a head and shoulders drawing made up of market prices. This chart pattern indicates a following downward trend for which a day trader looks for increased trading volume as part of confirming the strength of this pattern. The inverse head and shoulders has the reverse appearance and indicates a breakout to the upside. The world of Japanese candlesticks has a host of patterns that help day traders spot likely breakouts both up and down. Chart patterns are useful indicators in day trading. The beginning day trader does not need to know every single pattern. However, the wider one's knowledge in this regard, the more trading opportunities one will be able to spot during a trading day. There are a handful of chart patterns that are good indicators of an asset's price heading upward. These include the ascending triangle, the cup and handle, and reverse or inverse head and shoulders. In the case of the ascending triangle, an asset price has been heading up and then begins to fluctuate. The strength of the fluctuation diminishes as the top price remains relatively steady and the lows gradually converge to a virtual point of a triangle. This strengthening market price consensus commonly leads to a continued upward trend. The cup and handle pattern resembles a drawing of a cup as an asset's price falls and then rises again, tracing out the symmetrical inside of a cup. Then the asset price falls precipitously, creating a cup handle. This is the point at which a day trader may choose to buy, making certain to set their stop loss and take profit targets in case the handle has not finished falling. This pattern commonly goes into an upward trend that can be traded profitably. The inverse head and shoulders is a pattern which predicts the reversal of a downward trend. The first shoulder is generally part of the downward trend. It reverses, and then the asset price falls even farther. It reverses again and then falls to roughly the level of the first shoulder. When a day trader sees that pattern evolving, they should be on the alert for a price breakout to the upside and reversal of the previous downward trend. In all cases, it is wise to remain aware of the broader picture of forces driving a market and to use more than one indicator to guide your day trading. And always manage position sizes wisely and routinely, set stop loss, and take profit targets. The most common bearish chart patterns. Markets do not just go up. Thus, a day trader is smart to learn how to use the chart patterns that indicate the emergence of downward trends. Common bearish chart patterns include the double top, head and shoulders, and descending triangle. As a bull market starts to age, it is wise to be aware of the double top pattern. It is also smart to pay attention to trading volume as volume goes up as the asset hits the first peak. Trading volume falls as the price drops to a valley and falls even lower as the asset hits a peak price similar to the previous high. As the price then falls, traders commonly watch to see if it drops below the valley between the two tops. The head and shoulders is similar to the double top in that it predicts the reversal of a rising market. This pattern is perhaps the most accurate predictor of a bearish reversal, said to be accurate about 85% of the time. As with the double top, a day trader should watch market volume and routinely set their stop loss and take profit targets when trading based on this pattern. The descending triangle indicates a growing consensus in a falling market, with the lower part of the triangle providing a support level. When the price range comes to the tip of the triangle, and the asset price then falls farther, this strongly indicates a downward trend. As with all technical indicators, it is wise to use more than one to provide confirmation of one's assessments. How to confirm chart patterns with technical indicators. Because no single market indicator is infallible, one should always look at a day trading opportunity with more than one tool. In the case of chart patterns, adding an indicator like the RSI, or Relative Strength Index, provides a view of not only prices but speed and magnitude of price changes. By using a pair of moving averages, a day trader not only smooths out the static of a volatile market, but also is able to predict up and down breakouts when short and long-term moving averages cross over one another. And by paying attention to trading volume, one is often able to predict whether the market will continue on an upward or downward trend, or reverse due to lack of interest. Recognizing reversal versus continuation patterns. An issue that day traders routinely need to confront is whether an asset will continue trading up, down, or sideways, or it will reverse direction. Chart patterns like double tops or bottoms and head and shoulder or inverse head and shoulders help identify when a price trend will reverse direction. On the other hand, chart patterns like pennants and flags are useful in identifying when a price trend will stay the course. A bullish flag pattern indicates market optimism, a period of market uncertainty, and then an upward breakout. The point of learning these patterns is to be able to make sense of otherwise confusing market situations and trade profitably. When learning these patterns, it is wise to practice trading in simulation until profits are routine. To the degree that the concepts involved in chart patterns are not making sense, the day trader may wish to consider learning from someone like Day Trade Safe in order to become a benchmark professional trader. Thanks for watching. Please subscribe to my channel, and don't forget to download the free training guides in the description below.